This is your Swap Hunt Daily News for February 25th, 2026. Bitcoin is 2 days from a potential death cross, and institutional selling just hit a level never seen before in the asset's history. Markets are staging a bounce today after a brutal stretch of selling, but the backdrop remains deeply cautious. Sentiment is sitting in extreme fear, not far from the lowest readings of the cycle. The total crypto market cap has recovered some ground after weeks of sustained outflows, with broad altcoin strength today adding to the recovery attempt. Despite the bounce, the overall regime remains bearish, with the trend still pointing lower. This looks more like a relief rally than a structural reversal. Bitcoin may be 2 days away from one of the most closely watched technical signals in markets, a death cross on its 3-day chart. Analyst Ali Martinez flagged the pattern on X, noting that the 50-day simple moving average is converging rapidly toward the 200-day equivalent on that time frame. In each of the last 3 Bitcoin cycles, 2014, 2018, and 2022, this exact crossover preceded the final, most violent leg down before the market bottomed. The drawdowns were 52%, 50%, and 46%, respectively. Each one marked the actual cycle low. Martinez estimates the crossover could occur as soon as February 27th if current trajectories hold. That timing matters. Markets are already dealing with elevated selling pressure, 5 weeks of fund outflows, and sentiment deep in extreme fear. Adding a historically reliable bearish signal to that mix is worth paying attention to. To be clear, the death cross is a lagging indicator. It reflects price action that has already happened, not a prediction. And past cycles don't guarantee future outcomes, but the consistency of the pattern, 3 for 3 since 2014, has traders on edge. Glassnode also flagged separately that the realized profit-loss ratio recently slipped into loss territory. Historically, that shift has lasted more than 6 months before conditions stabilized. For Bitcoin to invalidate this signal, it would need to hold ground and push the 50-day back above the 200-day before the crossover completes. Right now, that window is closing fast. The person behind Capriole Investments, Charles Edwards, is calling this the most aggressive institutional net selling of Bitcoin ever recorded. The data is striking. Edwards tracks institutional activity by combining spot ETF flows and Bitcoin treasury company holdings, using the monthly rate of change as his proxy for institutional momentum. That number has just collapsed to negative 319% on the net institutional buying metric, a level the indicator has never reached before. To put that in context, during the brief January recovery, institutional entities were briefly absorbing Bitcoin faster than miners could produce it. That dynamic has completely reversed. Spot ETFs have swung sharply negative. Treasury companies are still net positive, largely because strategy continues to accumulate, but the ETF side of the ledger is deep in the red. Edwards raised one additional variable in his analysis, the quantum computing threat. He argues that rational investors are discounting Bitcoin's fair value today because of the theoretically rising risk of Q-Day, the point at which quantum computers could theoretically compromise older, vulnerable wallets. His framework suggests this uncertainty is adding a quiet discount to institutional valuations. Even if it's rarely discussed openly, whether you accept that framing or not, the headline finding is hard to dismiss. The most informed and best-resourced participants in the market are selling at a rate without historical precedent. A United States senator has formally opened an investigation into Binance over allegations the exchange facilitated roughly $1.7 billion in transactions linked to Iranian entities. Senator Richard Blumenthal sent a letter directly to Binance co-chief Richard Teng, requesting records related to dealings with Iran-linked accounts and asking questions about the alleged dismissal of internal investigators who flagged the activity. Binance has pushed back firmly. The exchange says it flags suspicious activity, maintains strict compliance procedures, and does not permit Iranian users on the platform. It did not deny the outreach but rejected the framing of the allegations. This matters for a few reasons. Binance reached a landmark settlement with the U.S. Department of Justice in late 2023, paying a multi-billion-dollar fine and agreeing to enhance compliance oversight. The company's leadership has worked hard to reframe the exchange as a compliance-first operation since then. A new congressional probe, even an informal one, reopens questions about whether that transformation has been complete. For institutional counterparties, regulators, and the broader market, the appearance of this kind of scrutiny on the world's largest exchange creates a layer of uncertainty that doesn't resolve quickly. It's worth watching how this develops. Step Finance, a Solana-based DeFi dashboard and tracking platform, has shut down permanently following a $27 million security exploit. The breach hit the project's treasury accounts directly, not a user-level smart contract. Selig confirmed that 261,854 ZEL was drained from the treasury during the incident, which occurred in late January. The team explored every available path forward: emergency financing, acquisition discussions, and potential partnerships. None of those options came together, and the team announced this week that Step Finance, along with Solana Floor and Remora Markets, two linked operations, are all winding down immediately. Token holders are facing a buyback process based on a pre-hack snapshot. The STEP token had already fallen sharply in the days after the breach, and liquidity around the token is now essentially gone. The shutdown is a reminder of how exposed treasury-level funds can be in DeFi projects, even for platforms with established track records. STEP Finance had been operating in the Solana ecosystem for years. Its closure removes a meaningful analytics tool from the network at a time when Solana's broader DeFi TVL is already well below its peak. For the Solana ecosystem, this is another difficult headline at a difficult moment. Crypto investment funds have now logged 5 consecutive weeks of net outflows, with the running total reaching roughly $4 billion across that stretch. The latest weekly data from CoinShares shows $288 million leaving fund products last week alone. Trading volumes fell to approximately $17 billion, the lowest level since mid-2025, signaling that even the investors still holding positions aren't actively deploying capital. The breakdown by asset is telling. Bitcoin absorbed the largest single asset outflows at $215 million. Ethereum saw $36.5 million exit. Short Bitcoin products, meanwhile, attracted renewed interest with around $5.5 million flowing into instruments designed to profit from falling prices. The geographic picture is divided. The U.S. led withdrawals with $347 million in outflows. Europe and Canada together added close to $60 million, with Switzerland, Germany, and Canada among the net buyers. CoinShares analysts framed this as a pause rather than a collapse. The argument is that sidelined capital is waiting for macro clarity, interest rate signals, economic data, and regulatory direction. XRP, Solana, and Chainlink each attracted minor inflows described as tactical positioning rather than broad risk on rotation. The key question for the market is whether this is consolidation before a re-entry or the beginning of a deeper structural exit. The SEC's crypto task force has a new chief counsel, and the pick is drawing attention. Taylor Lindman, who spent 5 years at Chainlink Labs, including time as deputy general counsel, has joined the commission as its senior legal advisor on digital assets. He replaces Michael Selig, who was recently appointed as chairman of the Commodity Futures Trading Commission. The appointment signals something deliberate. Rather than pulling from traditional financial regulation, the SEC installed someone with deep native crypto legal experience at the top of its primary digital asset unit. Chainlink's own announcement framed the move as an opportunity to modernize the U.S. financial system. SEC Commissioner Hester Peirce, who leads the task force, welcomed Lindman publicly on X. The broader regulatory picture here is notable. SEC Chairman Paul Atkins recently outlined plans to advance digital asset regulation through a joint initiative with the CFTC, which they've named Project Crypto. The two agencies are planning coordinated rulemaking, a shared taxonomy for crypto assets, and efforts to reduce duplicative compliance requirements. Atkins has been explicit that regulatory clarity is long overdue. Bringing in someone with hands-on experience building compliant blockchain infrastructure, rather than a career regulator, appears to be a deliberate signal about the direction the task force intends to take. That's your daily crypto roundup for February 25th. If this kept you informed, hit subscribe on Swap Hunt HQ here on YouTube and follow Swap Hunt on X for real-time market alerts. See you tomorrow.